At 2:47 a.m. Eastern on a Thursday morning in September 2008, a money market fund called the Reserve Primary Fund did something that was supposed to be impossible. It broke the buck. $1 invested was suddenly worth 97 cents. 3 pennies vanished from the safest, most boring investment vehicle in the American financial system. By sunrise, the Federal Reserve was on an emergency call. By noon, $300 billion in redemption requests had flooded money market funds across the country. By Friday, the Treasury Secretary was on his knees, literally, begging the Speaker of the House for a bailout authorization. 3 pennies, that's all it took to bring the largest financial system in human history to the edge of total cardiac arrest. Not a war, not a pandemic. 3 pennies in a money market fund that most Americans had never heard of. The system didn't almost collapse because of the size of the loss. It almost collapsed because of what the loss revealed. That the money people believed was sitting safely in their accounts was not where they thought it was. It had been lent, leveraged, rehypothecated, and scattered across a web of counterparty obligations so dense that no single institution could trace where the dollars actually were. The money was simultaneously everywhere and nowhere, and the moment enough people asked to see it at the same time, the system couldn't produce it. Now multiply that lesson by a factor that would have been unthinkable in 2008. Because what just happened inside the American banking system makes the Reserve Primary Fund look like a rounding error. Between 2022 and early 2026, approximately $4.7 trillion has quietly migrated out of the traditional banking system. Not transferred between banks, removed from bank deposits entirely, and redirected into money market funds, treasury instruments, and other vehicles that sit outside the banking system's balance sheet. The number comes from Federal Reserve data, from FDIC filings, from the bank's own quarterly reports. It was not announced at a press conference. It was not covered by a single major network broadcast. It was buried in tables and footnotes and flow of funds reports that nobody outside of institutional finance reads. $4.7 trillion. That's roughly the GDP of Japan. Moved quietly. While the financial press ran stories about stock market records and soft landings and the resilience of the American consumer. Here's why this matters more than almost anything else happening in the economy right now. Banks don't hold your money in a vault. You know this intellectually, but you don't feel it. When you check your bank balance and see $50,000, you believe at a gut level that $50,000 exists somewhere with your name on it. It doesn't. Your bank took your $50,000 and lent $45,000 of it to someone else. Maybe a mortgage, maybe a commercial real estate loan, maybe a portfolio of bonds that were worth par when they were purchased and are now worth significantly less. Your balance is not money, it's a claim, an IOU from an institution that is solvent only as long as every depositor doesn't ask for their money at the same time. The system works on a bet. The bet is that trust holds, that the line at the ATM never gets too long, that the 2:47 a.m. phone call never comes. For most of modern banking history, the bet has paid off. But $4.7 trillion in deposit outflows means a very large number of people and institutions have decided, quietly, to stop making that bet. Not because they think their bank will fail tomorrow, because they've done the math on what their deposits are actually earning versus what they could earn elsewhere, and the math sent them to the exit. This is the part that connects the deposit migration to something much larger and much more dangerous than a yield differential. The reason depositors are leaving is that interest rates rose faster than at any point in 40 years. The Federal Reserve took rates from near zero to over 5% in roughly 18 months. That move, designed to combat the inflation created by the Fed's own money printing in 2020 and 2021, created a problem the banking system was not built to survive. Banks hold long-duration assets, mortgages that won't mature for 30 years, Bonds purchased when rates were at historic lows. Government securities bought at prices that assumed interest rates would stay near zero forever. When rates surged, the market value of those assets cratered. A treasury bond purchased at par when rates were 1% is worth roughly 75 cents on the dollar when rates hit 5%. The bond still pays. It still matures at face value. But if the bank needs to sell it today to meet withdrawals, it takes a 25% loss. That loss is real. It's just not visible, because accounting rules allow banks to carry these assets at their original purchase price as long as they don't sell them. The losses are there, on the books, hidden by a classification trick that lets banks pretend a 75-cent asset is still worth $1. The Federal Reserve's own data showed unrealized losses in the U.S. banking system exceeding $500 billion at their peak. Some estimates, using mark-to-market accounting rather than the fantasy version banks are permitted to use, put the number significantly higher. $500 billion in losses that exist but don't officially count, that aren't reflected in the stock price, that aren't mentioned in the annual report's highlights section, that sit like an unexploded bomb inside balance sheets that depositors are told are rock solid. 3 banks learned the hard way in the spring of 2023 that unrealized losses become very realized when depositors leave. Silicon Valley Bank, Signature Bank, First Republic. Combined assets of over $500 billion, gone in days. Not because the banks made spectacularly bad bets, because they made the same bet every bank makes: borrow short, lend long, and assume depositors won't leave. The depositors left. The banks had to sell assets at a loss to meet redemptions. The losses consumed the capital. The capital went to zero. The FDIC stepped in. 3 banks, $500 billion. If you're starting to understand that the $4.7 trillion in deposit outflows isn't just a statistic, but a slow-motion version of the same force that killed 3 banks in 90 days, hit that like button right now. This isn't about engagement. It's about making sure this reaches people who still think the FDIC sticker on the door means their money is safe in all scenarios. It means their money is safe until the scenarios exceed the FDIC's capacity to respond. And $4.7 trillion in deposit migration is creating scenarios that no deposit insurance system was designed to handle. The FDIC insurance fund contains roughly $130 billion. It insures roughly $10 trillion in deposits. That's a coverage ratio of roughly 1.3%. For every $100 you have insured, the FDIC has $1.30 set aside. This works when failures are isolated. When one bank collapses, the fund covers it and the system moves on. It doesn't work when failures are systemic, when the underlying condition, unrealized losses on long-duration assets, exists across the entire banking system simultaneously. The failure of one institution doesn't relieve the pressure on others, it intensifies it. Because every depositor who watches one bank fail immediately questions the bank they're in. The phone calls start, the transfers begin, the deposits move, and the next bank's unrealized losses become the next realized catastrophe. This is the feedback loop that $4.7 trillion in outflows has been quietly constructing. Every dollar that leaves the banking system removes a unit of funding from institutions sitting on impaired assets. Every removed unit of funding increases the probability that those assets will need to be sold. Every forced sale realizes a loss. Every realized loss reduces the bank's capital. Every capital reduction makes the remaining depositors more likely to leave. The loop feeds itself, slowly at first, then all at once. The phrase all at once isn't dramatic license. It's the documented behavior of bank runs throughout history. They are binary events. The bank is trusted on Monday. It is besieged on Tuesday. The transition from confidence to panic does not pass through a moderate middle ground. It skips it entirely. The 2023 bank failures were contained because the Federal Reserve created an emergency lending facility called the Bank Term Funding Program. The BTFP allowed banks to borrow against their underwater bonds at face value rather than market value. Read that carefully. Banks could take a bond worth 75 cents to the Fed and borrow $1 against it. The Fed accepted the fiction as collateral. This kept the system functioning. It also established a precedent that every future crisis will invoke. When reality threatens the banking system, the central bank will suspend reality. The question is not whether this works, it works in the short term. Every emergency facility works in the short term. The question is what it costs, and the cost is always the same. More money creation, more dollar debasement, more purchasing power extracted from every person holding the currency to subsidize institutions that made bets that didn't pay off. The depositors who left were right. Their banks were sitting on losses. The Fed's response was not to fix the losses, but to hide them more effectively. The $4.7 trillion that moved was the market's verdict. The Fed's intervention was the government's overruling of that verdict. And every time the government overrules the market, the eventual correction becomes larger, not smaller. But here's where this becomes something more than a banking story. Something that connects to the deeper pattern running beneath every monetary system in decline. The $4.7 trillion didn't just leave bank deposits. It went somewhere. Most of it flowed into money market funds and short-term treasury instruments. Money market fund assets have swelled to historic levels, exceeding $7 trillion. That money is now lending directly to the U.S. government through treasury bills and repurchase agreements. The banking system, which traditionally served as the intermediary between savers and borrowers, is being bypassed. Savers are lending directly to the government and cutting the banks out. This sounds like a minor plumbing change. It is an architectural transformation. When deposits sit in banks, those banks use them to make loans, business loans, mortgages, lines of credit, the fuel that makes the real economy function. When deposits sit in money market funds buying treasury bills, they fund government spending. Not factory construction, not small business expansion, not housing, government consumption. The $4.7 trillion migration represents a massive redirection of American savings away from productive private sector lending and toward financing the federal deficit. The money that used to build businesses now pays for the interest on last decade's spending. The economy isn't being starved of capital by accident. It's being starved because the government is offering a better rate than the private sector can match, funded by a debt that already exceeds $36 trillion. The government is outbidding your local business for your savings, and your local business can't print money to compete. This is the mechanism that hollows out an economy from the inside. The Romans debased their currency and watched productive commerce retreat into barter. The Spanish flooded their economy with New World gold and watched domestic industry collapse because nobody could compete with imported goods bought with plundered metal. The British funded 2 world wars with debt and watched their manufacturing sector, the engine of the empire, wither because capital was redirected to servicing obligations instead of building capacity. The United States is running the same playbook. Capital is flowing to government paper because government paper pays more, backed by a central bank willing to create unlimited currency to honor the payments. The private economy slowly suffocates. The government sector slowly expands. And the statistics say the economy is growing because government spending counts as GDP, the same way a family maxing out credit cards would show rising household spending. The spending is real. The prosperity is not. There's one more dimension to this that transforms it from a financial concern into an existential one. The banking system isn't just where your money sits. It's where the Federal Reserve's monetary policy transmits into the real economy. When the Fed raises or lowers interest rates, it works through the banking system. Banks adjust their lending rates. Credit expands or contracts. The economy speeds up or slows down. That's the theory. But when $4.7 trillion in deposits have migrated outside the banking system, The transmission mechanism is broken. The Fed can set whatever rate it wants. If the money isn't in the banks can't lend it. If the banks can't lend it, the rate changes don't reach the businesses and consumers they're supposed to affect. The central bank is turning the steering wheel, but the wheels aren't connected to the road. This is the nightmare scenario that monetary economists write papers about and hope never materializes. A central bank that has lost control of its own transmission mechanism. A system so dislocated that the tools designed to manage it no longer make contact with the economy they're supposed to manage. And this is happening during what the government calls a period of economic strength. Imagine what happens during an actual crisis. A recession that triggers a wave of commercial real estate defaults. A geopolitical shock that freezes global trade. A treasury auction that fails to attract enough buyers. In 2008, the banking system was the channel through which the crisis was both transmitted and ultimately resolved. The Fed pumped liquidity into the banks. The banks stabilized. The economy slowly recovered. If the next crisis arrives, and the banking system has been hollowed out by $4.7 trillion in deposit flight, the Fed's fire hose is pointed at a building the fire already left. The liquidity goes in, but there's no mechanism to push it out into the economy. The result is what Japan experienced for 30 years. Central bank intervention that inflates asset prices while the real economy stagnates. Enormous monetary expansion that produces no growth, only inequality. A stock market that rises while Main Street decays. Sound familiar? It should, because the preliminary symptoms are already visible. Subscribe to this channel and turn on notifications right now, because what happens next in this deposit migration will determine whether the banking system's slow bleed stabilizes or accelerates into something the emergency facilities can't contain. We're tracking these flows in real time. Every Fed report, every FDIC filing, every quarterly earnings call where bank executives try to explain why deposits keep leaving while insisting everything is fine. The next video maps the 3 specific triggers that could convert this slow migration into an acute banking crisis and what each scenario means for your savings, your mortgage, and your access to your own money. So what do you do when you learn that $4.7 trillion has quietly exited the system your money sits in? First, you stop assuming your bank balance is the same thing as money. It's not. It's a claim on an institution that holds impaired assets, insured by a fund that covers 1 cent of every dollar it guarantees. That claim is good in normal times. These are not normal times. These are times when the banking system has absorbed the largest interest rate shock in 4 decades while carrying the largest unrealized losses in its history. Understanding that your deposit is a loan you've made to your bank, and evaluating the creditworthiness of that borrower the same way you'd evaluate any other borrower is not paranoia. Second, understand what the migration is telling you. $4.7 trillion doesn't move by accident. It moves because the people and institutions controlling that money calculated that the banking system offers an inadequate return for the risk it carries. These aren't conspiracy theorists. They're treasury departments at Fortune 500 companies. They're wealth managers at family offices. They're CFOs who read balance sheets for a living. When the most sophisticated money in the economy quietly exits an institution, you should pay attention to the direction they're moving, not the reassurances coming from the institution they left. Third, recognize the historical pattern. Every major banking crisis in modern history was preceded by a deposit migration that the authorities called normal and manageable. The savings and loan crisis of the 1980s, the Japanese banking collapse of the 1990s, the 2008 global financial crisis. In every case, the official position was that the system was sound until the moment it wasn't. The deposits left gradually, then suddenly. The losses were unrealized, then realized. The insurance was adequate until it wasn't. The language of reassurance is always identical, because the incentive to reassure is always identical. The system requires your confidence to function. Telling you the truth would destroy the confidence. So the truth is the last thing you'll hear from the institutions that need your deposits to survive. Fourth, diversify beyond the system that's showing stress. Not out of fear, out of arithmetic. Gold doesn't depend on a bank's solvency. Real estate doesn't vanish when an institution's unrealized losses get realized. Bitcoin doesn't sit on anyone's balance sheet as a liability. These aren't speculative alternatives. They're the assets that have preserved purchasing power through every banking crisis in history, for the simple reason that they exist outside the system that's breaking. The $4.7 trillion that left the banking system didn't make noise. It didn't trend on social media. It didn't trigger a congressional hearing or a primetime special report. It moved in quarterly increments, reported in footnotes, buried under headlines about inflation cooling and markets rallying. The silence isn't accidental, it's structural. The same system that needs your deposits to remain solvent controls the channels through which you'd learn that solvency is in question. The information asymmetry isn't a flaw, it's load-bearing. The moment depositors understand a system as clearly as the people who just removed $4.7 trillion from it, the system faces a test it has not been engineered to pass. In 2008, 3 pennies broke the buck and nearly broke the world. The system was saved by emergency measures so extreme they redefined what governments are willing to do to prevent a banking collapse. Those measures bought time. They didn't fix the architecture. The same architecture is still standing, more leveraged, more fragile, more dependent on confidence than at any point in its history. And $4.7 trillion in confidence just walked out the door. The people who move that money are not waiting to see what happens next. They've already made their assessment. They've already acted on it. The question is whether you'll read the same data they read and reach the same conclusion they reached, or whether you'll wait for the press conference that never comes. Drop a comment below and tell me, where are your deposits right now? Are they in an institution sitting on unrealized losses that accounting rules allow it to hide? Are they earning a rate below real inflation while money market funds offer twice as much to lend to the same government your bank lends to? Did you know that $4.7 trillion had left before you watched this video? Because the gap between what you knew and what the sophisticated money knew is the gap where your financial future is being decided. Without your input, without your knowledge, without your consent. The money moved. The question is whether you'll move with it, or be the last one standing in a building the smart money already left.